Guess who's here? Ross Gibbons, market watcher. We like to see this guy because he says the Dow Industrials will hit 20,000 by the end of next year. Make your case.
That's correct. Well, thanks for having me on. See, here's what I think everyone misses, Stuart. You know, they look at earnings multiples or, where we are in the market and judge today based on history. The difference is when you look back, we weren't in a zero interest rate environment then. So when you look at, you can get a 10-year Treasury bond that pays 2%. You can get a corporate bond that pays 3 or 4. Stocks at 17 or 18 times earnings are therefore yielding 6% plus the corporate growth. You just can't find that anywhere else.
So the profitability of American corporations at this moment justifies a higher level for the Dow Jones Industrial Average in the future.
Correct.
That's your case. And there's nowhere else to go because you go to a bank CD, you go to a bond, you get nothing. The stock market gives you something. That's the point?
Exactly, yeah. When you look at historic yields in the market, it's all about what it gives you compared to your alternatives. And when the alternative is a 2% note from the Treasury, a 6% yield from a stock that is going to continue to grow is very attractive.
Okay, how about Apple? I think you like it. It's 123 right now, and
Correct.
You would buy it?
Oh, I'd absolutely buy Apple here at 123. This is a stock that is definitely cheap compared to the rest of the market. It's one of the greatest companies.
Apple is cheap compared to
Well, it's tough to say cheap because you look at it and say, hey, here's a $600 billion giant, right? Now, when I say cheap, I'm referring to based on what the company's earnings, the profits and the sales they're bringing in the door.
The relationship between the profit it makes and the price of the stock. You say it's out of whack and it's cheap on that basis.
Correct.
General Motors, I understand you like it at what, 34, 35, 36?
Right, yeah, trading around 35, 36 right now. And this is a really simple case. Even someone who's not extremely investment savvy can understand. The company's on pace to make about $5 a share in earnings. The stock's trading at 35. So you're buying this stock for 7 times what they're about to start making on an annual basis.
Yeah, but it's General Motors. I mean, how long since any of us bought U.S. Steel, General Motors, Ford Motor Company? I mean,
Well, that's why it's so cheap, right? I mean, you've got a market. It'd be one thing if the stock was trading at 12, 13 times earnings and the market's at 15 or 16. It's a little bit of a discount. We're talking about a stock trading at half, less than half of what the bulk of the broad-based market is. So it's extremely, extremely cheap. There's negative sentiment around it.
All right. To repeat, 20,000 easy by the end of next year. Ross Gibbons.
20,000.
On November the whatever it is, the 4th. Right?
On November 4th, right. Into 2016, we'll see 20,000 on the Dow, and I'll be back to...
On the record now.
On the record. Okay. All right, we heard you. We got you. Ross Gibbons, thank you very much.